Okay, welcome.
Why are you look confused?
No, I had like too many
Screens?
too many tabs. Too many tabs. Story of my life. All right, welcome. It's Tuesday night. Michael and I are here. We're gonna play our favorite game. What are your thoughts? We're gonna go at it tonight. No, I'm just kidding. I think actually just looking at the topics, we probably agree on most of the stuff we're gonna get into, but it's all really important because it does feel that over the last couple of weeks, the market has entered into a new phase, and we're gonna tell you our takes all about it. But before we do, we have a sponsor tonight. Michael, who is our show sponsor?
We're going back to the FTX. Well, back to Miami tomorrow. Is it tomorrow? It's too much with these every other night games, but back to FTX Arena. Listen, they're rolling out this beta thing. You can trade stocks, cryptos, and NFTs. So you could lose money everywhere in one place. you don't have to time travel anymore. But listen, they're gonna.
That's very
here's
bottom
the deal.
That's very bottom.
Okay, well, they're gonna route all their orders, at least to start, through NASDAQ. You know what that means? No PFOF.
No payment for order flow? So then how are they going to make money?
Don't worry about that.
Okay.
No free brokerage accounts, commissionless trading, the whole nine, all in one spot.
Maybe it's less important to make money now and more important to capitalize on some of their biggest competitors starting to wobble a little bit.
Are we still talking
reasonable.
about TAM? Are we still doing TAM in this year, 2022?
I feel like some companies can still do TAM. Most can't. Hey, Miami can't win unless they cheat. Is that basically what's going on?
What are you talking about?
They have to be committing like shady fouls in order to stop Boston from doing anything. Is that basically?
It's a 2-2 series.
Yeah, I don't know. I feel like Miami's a little bit shady. Doesn't matter. Let's say hello to some of the folks before we get into our first topic. Jay Luther is here. Warren Z, Cliff Peebles, Brian Grill is back. Got a lot of regulars here tonight. Ben Phillips, hello. It was nice meeting you recently. Ben Phillips was in the office last week. Do I have that right? Okay.
Thursday.
Young man starting a podcast aimed at Gen Z investors. Very cool stuff. Who else is here? Bits of interest. Says chart on. I agree. Charts in a minute. Hello, Roger. Idea Shop. David, I see you. All right, let's get into it. You have the first one, and I think it's the big one of the week, quite frankly.
You might have noticed, this is from FactSet, S&P 500 companies are seeing the largest average negative price reaction to negative EPS surprises for Q1 since 2011. Interesting, 2011. By the way,
walk me through the chart, though.
Hang on, before you get to the chart, back it up. Let me show that tweet. Who runs this account? Hashtag earnings insight?
Who runs the hashtag FactSet account? I don't know. It might be an algorithm. It might be Jay Powell. Who really knows?
Okay, so
what is the chart showing
obviously,
us?
This is showing exactly what it looks like it's showing. What is that? No, I'm just kidding. So when companies report earnings, and by the way, can I just say, I think maybe we should cancel earnings calls until we could figure out what the hell is going on.
Yeah, let's stop this nonsense immediately. I see no benefit to this at all, quite frankly.
Okay, so anyway, so if you issue a beat, your stock's like flat. If you miss and guide down, you're basically down, 90%. Look, I've made a chart of Shopify just to show like the volatility of the market these days. And Shopify was the first high beta stock that I chose. It could have been anyone. This is for the month of May. These are daily price changes. The average absolute daily price change, so strip away the negative, just the average daily move, is 7%. These look like monthly returns.
It's crazy. The CEO of Shopify, not to go off on a tangent, so I want to stick with earnings, was the guest on Patrick O'Shaughnessy's last episode, I guess from this weekend. I made it one question deep. Patrick, he was on the show 2 months into COVID, and shit was going crazy for Shopify to the upside. Obviously, e-commerce was exploding. It was perfectly timed. He had him back for some reason this week. I don't really know why. And he asked him one question, and the guy spoke for 26 minutes. One question, and I just said I had to tap out. I can't listen to people talk like that. So I don't even know what he was talking about, quite frankly, but it was way too much. All right. Zoom and Snap earnings this week seem to have knocked the market for a loop. Zoom was an upside surprise. Not that it matters. The
What are
company
the details here? What happened?
company
They
went
raised.
into earnings down 85% already, the stock. So it almost didn't matter what they said. They could have said we're folding, and it probably would have been an upside surprise. Where we have the details. So they did 1.07 billion in revenue, which was expected, and they earned $1.03 versus 87 cents. Revenue growth was up 12%, down
not
from
good.
200% the year. No, of course not. But what were what were the expectations? Again, this is a stock that is down 85% from its high. Did anyone expect them to do anything decent?
Wow, gross margin 76 to 78%.
Raised full year earnings guidance from the high end of the range 351 up to 377. Also not something that we're seeing a lot of. 198,900 enterprise customers. That's up 24% year over year. Revenue from enterprise customers is up 31%, which is half of their total revenue. So I think maybe the positive thing here is not a lot of people understood that half of this business is now enterprise business, and they're doing a lot with large corporations, and maybe that, I'm not saying saves the stock or makes it more investable than it already was, but maybe that puts a floor under it because this is not just a consumer fad. It's not Peloton. This is a company that other companies are happy to pay. I think we pay them, not a lot, but I think we have an enterprise license with them of
You know,
some
just
sort.
anecdotally, I feel like more and more of my meetings are coming through Google Meets. I got a
me too.
Microsoft one today, which was
Google,
kind of annoying.
the Google Meets are too easy to set. Especially if you're
I
using
transitioned.
Gmail.
I don't use Zoom anymore.
Yeah, if you're using Gmail and setting up calendar invites with Google Calendar, way too easy to just throw a Meet link in there.
Throw up the chart of Zoom slowing growth. No. This one, yeah. So, all right. So this, you see what happened to the stock? Crushed.
Yeah, this is one of those things where you didn't need to wait 10 years for the effect of competition. It's basically they had like a head start for 6 months, and now it's an interchangeable commoditized product, and they're fighting it out with Google and Microsoft, and that can't be any fun.
I don't understand what this is weird with Snap. They've reported earnings like a month ago.
This is to me one of the things that really freaked the market out the most. So Snap is inconsequential. It's a tiny company. It's like $1 billion and change in revenue. It's not systemically important. It's not even important within tech, but it does command a lot of attention as a stock for some reason. I'm not sure why, right? It trades 50 times earnings. I don't know why. It trades 6 times sales. I don't quite understand why. But for whatever reason, it's a big, important stock. This is what they said. Today we filed an 8K sharing that the macro environment has deteriorated further and faster than we anticipated when we issued our quarterly guidance last month. April 21st. They gave good guidance, and now they're saying, look out below. Snap said it's likely to report revenue and adjusted cash flow below the low end of its guidance. Company said in late April, second quarter revenue would be between 20 and 25% year on year, EBITDA between break even and 50 million. So they might actually have negative cash flow, and if they're saying growth is below the low end, it's probably appreciably below. So this is what? The advertising market falling apart in 30 days? Does that seem likely? Or were they maybe a little bit too ambitious when they gave guidance a month ago? What do you think?
I mean, it's hard to say because they're not the only ones that were warning of a slowdown. I mean, Facebook. So the only thing is, like, people have said that this is more TikTok than macro, but in the last 30 days,
I don't believe that it's more TikTok than macro.
you do believe that it's macro.
TikTok and Snap are not used the same way. They're just used by the same people. They're used by the same generation, and they might fight for ad share, but Snapchat is not a social network. Snapchat is a camera app, and it's for messaging. You don't use it the way that you use TikTok. You don't go viral on Snapchat. It's one-to-one conversation for the most part. And then they have some features that allow brands to do content, but it is nothing like TikTok. So I don't know that there's as much head-to-head there as people are saying. They're
Well,
also
the market is acting as this is going to be a thing because how much was Google and Facebook down today? I think Facebook's down 8%.
I heard people say this also has to do with some of the changes Apple made to its privacy rules in the App Store.
That was already reflected in the last call.
And then I heard somebody say that no, actually, there were supply chain issues with the spectacles, which are now in their 4th incarnation, which I also have a hard time believing that would matter. How many people are buying Snapchat spectacles a year? 8 people? 12 people? I've yet to see them in the wild. So I think it's exactly what we think it is. I think it's advertisers pulling in their reins. Yeah. Did you see what they did to the advertising stocks today? Trade Desk, Interpublic Group. I forget all the names, but on average they were down.
Holy shit! Trade Desk down 18%.
They crushed it.
Whoa.
They murdered it. I don't even want to look at Roku or some of the other next gen advertising plays.
I was writing about this today. It does seem like the bad news is really piling up very quickly. With inventory build all over the place, we saw the really big new home sales miss today.
Throw up the Snapchat stock chart year to date.
Not bad.
What is going on? Throw up the lifetime. So like,
oh my!
I'm a long term shareholder. You know what's funny? If you had this chart up and you had monthly average users plotted alongside of it, I think the user base keeps growing, and it doesn't matter because the starting valuation and the narrative and all these things are just more important. And this is a really good example of that, or bad example of that, I would say.
I was looking. So Carl Quintanilla was tweeting about Snap today. I'm turning my head to see. I can't really see. But it shows the employee options percent that are underwater, and it looks like 43% of employee options are underwater at Snap. That looks right behind Chewy, Lyft, Peloton. I can't quite read the others, but yeah, not pretty.
So 43% in dollar, 43% of all of the stock options that were issued
granted to employees. So this is where we spoke about this on TCAF. This is where the market is the economy because they're using their stock as currency to pay employees. By the way, you saw what Coinbase did? They like topped off their employees. They're like, we know that you got killed. Here's some more. We'll refill the coffers.
Well, this is where the stock market is the economy in specific regions of the country. I don't think this affects the housing market in Oklahoma, right?
Or industrials. No, this tech. It's tech.
I think there's a huge impact on the West Coast, and it won't only be felt in real estate. It'll be felt in consumer spending on all sorts of shit, and it'll also be felt in the form of tax receipts. Would anyone disagree with me when I say tax receipts for the year 2022 are not going to be as much fun to count as 2021? Probably nobody would disagree with that. So you're going to see the impact of this all over the economy, understanding that the stock market's not the economy. Stock market has huge ramifications for the economy, which I think we're gonna talk about that a little bit later. I wanted to say that the stock market this week feels like, or the last 2 weeks, it feels like a minefield. And every stock is either a blown up landmine or a potential landmine that has not yet blown up. But if you step on it, will be detonated. And I mean, really. And it doesn't matter what sector.
Except for Exxon.
Yet. So I would just say, like, when you're in a landmine, even if you're 10 feet in and you see like arms and legs flying through the air, and just hear screams and explosions all over the place, at a certain point, you stop running forward. Like, at a certain point, you stop jumping on the next step to take. And I think we're there. And I think we really didn't get there probably until this week for most investors.
Last week.
Last week, right.
Yeah.
But I really have that sense that that's where we are right now.
Well, I think when you see Walmart and Target, or what did Target that lose 25% in a day, they're coming for you. It's Target.
Target is down. I know you hate this. It's down 100 points in like 3 weeks. So if you had 1,000 shares, you're down $100,000 in Target.
I'm not letting you do this.
I'm just saying. I'm just making the point. It's a lot. It's a lot. It's a lot of scratch, kid.
Yeah,
It's a lot-
we know. Yeah.
All right.
So are you selling yet?
Well, let's go into panic selling because
I tried to throw you a softball. You didn't take the segue.
A segue. Okay. New study appears in the winter 2022 issue of the Journal of Financial Data Science, which I almost never miss an issue. So
Time out. I have to say, you're right. When we're talking about journals, then it's of financial something.
Yes.
Otherwise, it's finance. When you say journal,
The Journal of Financial Data Science. Right. Finance. Correct. When do investors freak out? Machine learning predictions of panic selling. We could throw out the machine learning part. I think they're just counting.
What do we need the machines? Yeah, we know.
The machines aren't doing shit. The study was conducted by a number of researchers at MIT. Panic selling occurs when, this is how they define it. Panic selling occurs when an investor intentionally sells off a substantial portion of his risky assets abruptly. The researchers specifically define as a decline of 90% of a household's equity assets over the course of 1 month, of which 50% or more is due to trades. So this is like, take me to cash, basically. That's what they consider a panic sell, not trimming stocks or anything like that. So who is the most likely candidate to start panic selling stocks? Literally me. 45-year-old. 45
People named Josh Brown?
No, but very close. I want to go through their list and just get your reaction one by one.
Okay,
This is
I'm not looking.
650,000 individual brokerage accounts studied between 2003 and 2015. The data set contains substantial details for many of the account owners, allowing researchers to correlate the frequency of panic selling with various demographic variables. They found the following variables to be correlated with the frequency of panic selling. Age.
Bald?
No. Maybe. I didn't get that far. People older than 45 have a heightened tendency to make panic sales. Younger investors are less likely to make panic sales by a wide margin. Would that have been obvious to you?
Yes. I mean, yeah,
Okay.
to you too, because the older you are, the less time you have to refill the coffers.
Also, the more dollars are at stake.
True.
The bigger the account. Okay.
True.
Marital status. Investors who are married or divorced. Hold on. Investors who are married or divorced are more likely than other groups to freak out. Wait, what's the third choice? Oh, not
Single?
married yet? In a thruple, maybe. I don't know. I guess single.
Yeah, that
like
makes
not
sense.
married yet.
That makes sense. That makes sense.
I think that's just another way of saying young and old, don't you?
But yeah, well, because what if your spouse is like, "What are you doing? Why aren't you protecting our nest egg?"
Oh yeah, that's a fight that's a fight every day in a market like this, for some households. Okay, gender. Males are slightly more likely than females to panic. What do you? I mean,
I'd say significantly more.
This would have been very intuitive. We don't need the machine learning for this one either.
Yeah. What else?
Why do you think males are more likely than females to panic sell during periods of high financial stress?
Overconfidence.
Okay, so they get rattled when they lose their confidence because it was too high to begin with. I have a different theory than that.
Although panic selling does not signal overconfidence, but maybe like overconfidence that you can get out and get back in. I don't know. What do you think?
I'm going to tell you that I think it's because the male is still in America more likely to be the primary breadwinner of the house. Therefore, it's the money that he feels he earned, even though we know that's like an outdated way of thinking. It's still prevalent. It may not be in 20 years, but right now that's just how it is. So I think that aspect of it, like I worked too hard for this money to watch, but then the other part of it, every man that I know, whether they know it or not, has this like savior fantasy somewhere subconsciously embedded where like they want to be the one that was right when everyone was wrong, and they want to be the one that saves the day, and they want to, there's like a, I think it's genetic. I think it's like there's something to this that is like just in our DNA for thousands of years. Men in particular have this complex that they like want to be the hero. And I think it probably
like what
has,
I'm going for with ego. It's better. You said it better.
Yeah, I think it just has something to do with like, I saved us. Don't worry. Like, I got this.
Right. Yeah,
and it,
totally.
of course, doesn't. All right. Number of dependents. Investors with no dependents are least likely to panic sell. It's another way of saying young versus old or married versus single.
Is this what Henry Hill and Karen are fighting about?
Yeah. Karen, I'm still gonna go out. This is interesting. Self-declared investing experience. The likelihood of panic sales and freakouts is most pronounced when the investor has self-declared good or excellent investing experience.
Of course. I've seen this movie before.
Why of course?
Because you know a little, you think you know a lot.
I think that's true.
Right, there's like what's like the arc of like time and how much you think you know.
Yeah. I think that's true. The other thing is if you're somebody that's telling everyone I have investing experience and you know what you're doing, you're probably somebody that watches it too closely. And the more you watch it, the more likely you are to think that you're supposed to take action or do something. So I think there's some correlation there. Self-declared investing knowledge, similar to investing experience, we find that investors who describe their investment knowledge as good or excellent panic sell or freak out in higher proportions. So kind of the same sort of thing, right?
It's all the same thing.
All right. You can read the rest of Market Watch if you want more details. Most of that was intuitive to Michael and I, just having been working in the field for as long as we have been. But I thought that was interesting. Okay, what do you got?
All right. Michael Sembelis did this post for JP Morgan. He called it the bear market barometer, and I thought this was well said. He said, a bottom for equities is likely to coincide with a peak in inflation. I don't think we're there yet.
A peak in inflation or just past the peak?
Well, whatever. Fine.
Well, I mean, I don't think a bottom will coincide with a peak. I think a bottom will come once it's obvious
Before?
that the peak is
or after.
In the rear view.
Wait, this is interesting. Do we think that equities are going to sniff out the peak in inflation? Will stocks bottom before inflation pops in anticipation of? Will they bottom when inflation peaks, as Michael said, or will they only bottom after we know conclusively that inflation has peaked by way of maybe 2 consecutive reads? I think that stocks will bottom before.
You know what's going to rock this market when some measures of inflation peak and it rallies on that, and then other measures of inflation get worse, and then we have to retrace it all, because that's historically how these things. Inflation is not all one thing; it's a great variety of things, and unfortunately, they might not all peak or bottom or rise.
Fine, but let's just use CPI. Let's just use CPI. What do you think stocks will bottom with it, before it, or after it?
Dude, the more days that go by with my bond market bottom call, the smarter I'm looking. Today I look like a genius. I think it's very likely that the deceleration in CPI becomes really apparent with the next reading. And all I need to go on is the stock market crash and new home sales crashing all in the same month. And I think now we're now going to see. Remember how we talked about everything speeds up? I think the effect on consumer sentiment has been so powerful over the last month. Obviously, the kid that runs Snapchat does too. That we might see an appreciably lower inflation read for the month that we're in right now, and that might spark a massive summer rally. I would not discount that possibility. I really wouldn't. So, will stocks sniff it out in advance? I don't know. Arguably, they'd have to start doing that now if that's what's going to happen. But you're not going to get 100% growth in oil this year. We just had 100% growth in the price of oil. That's not going to repeat. Like, there are certain things that are mathematically impossible for the inflation rate to accelerate from here.
If sentiment has not been fully flushed out yet, right? Like,
We're very close. We're very close. The thing is, we haven't really had the layoffs yet that would normally accompany what you would consider like a washout.
I'm saying sentiment. I'm saying it's sentiment.
Yeah, I don't know. It might be too early. I hope I'm wrong. What's this? What's this drawdown Nasdaq chart?
So it's kind of a confusing way to visualize this, but the TLDR is that 1/3 of NASDAQ stocks are down 70%. And by the way, this chart is a week old, so it's worse. Half of NASDAQ stocks are down 45%. I'm going to say half are now down 50. It's really
This is
bad.
from JP
It's really, really
Morgan.
bad. It's really bad.
It's remarkable how widespread the damage is, considering that we're really in the first quarter where the earnings guide downs have become obvious. It's not like it's been a year of this and stocks are crying uncle. It's really only been a few weeks of negative earnings pre-announcements and such. If you think about the fourth quarter reports in January and February, we're all really strong. So we're very early in the process, and we've discounted a lot already.
I agree with that. He said when real treasury yields went negative in 2020,
We have this chart
that's
too,
when
right?
that's when PE multiples shot up over 20x. And now that real yields are moving into positive territory again, PE multiples are declining. So that's the chart on the left I'm talking about. It's inverted, okay? So when you're seeing the yellow line or the gold line go down, that means that real yields are moving from negative to positive, and they're compressing multiples. But he's right. Look at when real yields were negative. So that's again, it's counterintuitive, but the yellow line is going up as real yields are getting more and more negative. That's when you saw the multiples just go bananas on all of these high beta names in 2020.
So now it's the reverse of that. And it looks like we haven't quite wiped that whole thing out. But
This-
that's
and
where
this-
it looks like we're on the way to.
This is interesting. So Michael says the more positive real yields become, the more equity multiples are likely to fall. That's why I'm less focused on earnings right now. This correction so far is all about overpriced multiples finally coming down. So we've seen that part of it, okay? We're obviously seeing a reset of multiples, which is good. There was way too much excess in the markets, obviously, everywhere. That is now being corrected. We're probably going to overcorrect. Maybe arguably we already have. But the problem is you saw the multiple compression. We haven't seen the E come down. And that's when it could get, that's when it can go from bad to worse.
Right. So think about the psychology when all of a sudden multiples are still falling. So we're paying less for earnings, and
so
earnings
earnings.
themselves start to implode.
We haven't seen that yet.
We have not seen that yet, and we may not, or in some sectors of the market we may, and in others maybe not. We don't know. Who is it? Is this
but John,
David
people are
Kelly?
saying
Is this
like
David Kelly?
it's Sembless. But before we get to the next chart, so
Sembless.
we're saying like stocks are trading at, I don't know, whatever it is, 16, 17 times trailing 12 months. That's not expensive, right? It's not. But it could be 22 times next year. We just don't know what the E is going to be.
That's why this is different from '08. In '08, there were legitimate systemic issues, credit issues, all kinds of like blowups. That's not what's happening here. Now we just have stocks that are too expensive for a world with positive real yields. And it doesn't feel any better. It feels just as bad. But
It does feel
it's
just as
not
bad.
happening for the same right. It's not happening for the same reason, but so what?
This is a normal cycle that we haven't felt in a very long time, right? Things
Yes.
got too expensive and now they're coming back down. All right, so Michael said this cycle is reminiscent of 2001 and 1987. Extended valuations finally coming back down to earth alongside what might be a shallow recession. That's quite different than '08 and 91 when the primary issues were banking sector solvency, over-leveraged households, and a housing crash. Thank God that's not what this is. So he said that's why most of the
Yet.
damage is seen in equities rather than in credit spreads. Throw up these charts, Big John. So we've mentioned this a bunch recently. How come spreads are not really reacting to this? Because of what Michael just said. There's no stress yet. John, do we have this chart?
All
right, maybe
bear
not.
market barometers.
There we go.
There we go.
There we go.
Okay.
So look at this compared to 2020. We got nothing. This is
So the blue line is the high yield spread, which is junk bond yields above the comparable treasury. And the red line is emerging markets, the same thing. Okay. Right. So there's no sign of distress anywhere in sight. Look at this guy. Bless you. Bless you, cutie.
keep going.
All right. We're gonna go to 81% predict a recession. This is higher than I thought it would be. CNBC survey says 81% of Americans believe we'll be in a recession this year. There's a former SEC chief economist who says time to prepare for recession. I found that this was way early, that we would have 8 out of 10 people expecting a recession. Are you surprised by this at all?
Well, not really, because everyone knows it's coming.
It's not supposed to be that easy for everybody to know it's coming. It's not supposed to be this way. Am I wrong? Aren't we also supposed to be surprised?
Well, we say like it's never what you see coming, never, but everyone saw this coming.
Our friend Haley Sachs is already preparing her campaign. She wants to call it the recession. She's like a little bit excited about it, maybe too excited about it. But it shouldn't be this easy for us all to spot a recession in the making. But maybe in the modern era, maybe it is.
But that's why sentiment has been so washed out. That's why cash levels are so high. It's pretty obvious.
John, do we have these headlines to just whip through real quick? All right. Goldman Sachs' former CEO, Lloyd Blankfein, says U.S. at very, the second very is key, high risk of recession. Next. J.P. Morgan CEO warns of powerful forces threatening U.S. economy into a recession. What else? A major recession is coming, Deutsche Bank warns. I think they were the first this time. Bank of America sees 1 in 3 chance of a U.S. recession sometime next year, but it will be mild. Okay, that's good. I like it spicy, but mild is fine. Top Morgan Stanley strategist. The odds of a recession have gone up materially. Stocks could fall another 50%. What's next? Yes, maybe. I don't know. Halfway? Flip a coin. Next. Barclays. Sure. Anyone else? Okay. If enough people think we're about to have a recession, don't we just have a recession because they start acting that way?
Yeah, maybe. And it doesn't matter. Gas is $5 a gallon.
Right.
This is not a psychological thing. It's like real.
So if it's not a recession, but you cut back your spending as though it's a recession just to fill your car up or to get groceries, then what's the difference? Might as well be.
But it's also going to be, what Ben and I were talking about today, there's going to be different parts of the economy that feel differently. Services, especially concerts like we were talking about last night, you're not going to see recession numbers there, God will, right? Unless like the wheels really fall off. But Home Depot, durable goods, people already did that.
That's right. So now does the services side have a recession? I think eventually. Not yet, but eventually.
Disney. Like how much pent-up demand is there still for Disney?
I think everyone's shooting their shot this year. All right.
But it's one time, so you're right. All right, let's move on to this. So we spoke with McMurtry about the impact. Like Dan said, if crypto went to, or you said if crypto went to zero, would it bleed over? And Dan was like, absolutely not. So this chart comes from, I don't know who, but the effect of crypto price fluctuations on household spending are likely small relative to changes in equity prices. All right, we know that intuitively,
I think
right?
This is Bank of America. I think this is HeartNet at Bank of America. I'm not sure. Okay.
That's pretty obvious. But look at this next chart. So asset holdings, this is from FinTech Frank. I don't know where he got this from. Asset holdings as a percentage of net worth. Crypto, it's 0.3%. Could this go to zero and have it not bleed over to other assets?
He had to use two different y-axes because the numbers are so incongruent with each other.
I think so.
I'm on the same page here, and actually there's a new Federal Reserve study on crypto use. The Federal Reserve estimates that just 12% of Americans, or 40 million individuals, used cryptocurrency last year, mostly as an investment and not a currency. I would say mostly as a drug, but fine, according to a new survey from the Federal Reserve. So it's only 12% of Americans. That's not big enough or widespread enough to cause a recession. The other 88% of Americans went on dates with girls. 11% said they bought or held.
Your aggression will not stand.
All right. 11,000 U.S. adults between October and November 2020. All right, doesn't matter. The point is, it could hit sentiment much harder than its actual dollar-for-dollar impact would be on the financial system. Do we agree on that? Like, if it gets materially worse, it could have a bigger effect just on overall sentiment than it might on the economy. What do you think about that idea?
Do we agree that overall macro sentiment is impacting crypto versus the other way around? Crypto is not impacting stocks at all. Stocks are impacting crypto.
If crypto were to suddenly lose half its value overnight, I think there would be a feedback loop into all risk assets. I don't know why, I don't know how, I just do. I just feel like that's the kind of thing that gets a lot of people's attention. I mean, listen, not that this is systemic, but like people were talking about how tiny subprime was. People,
I know,
there were
I know.
1,000 articles between 2006 and 2008 about how small it is, how few people take a subprime loan, how they're just poor people anyway who care. Like there was this whole
Apples and calculators.
maybe not. I don't know. All right, last thing. Who before we get to viewer topics, who is wealthy? Did you get any time with the Schwab Modern Wealth Survey? Did you look into this at all? Thought it was pretty cool.
Anti-survey.
Well,
Not
this
in
is
this
them
case, I know.
serving.
I know.
This is them surveying their actual clients, I think. So they know a little bit more about what they're saying. 1,000 Americans ages 21 to 75 were surveyed in February 2022, and the average net worth needed to be considered wealthy, according to these 1,000 people surveyed by Schwab, both rose from last year. In 21, Americans said they needed 624,000 in net assets to live comfortably. This year, 1.9 million.
That's inflation.
That's inflation, right? That's crazy.
You know what's interesting? I don't think about wealth in terms of net worth. I think about it in terms of income.
I think about it in terms of how many friends you have. No, what do you mean in net income? Like how much money you make a year?
Like in order to feel wealthy, to me that's like an income thing more than an asset thing. But maybe that's not right.
Probably a lot of correlation between high income and high assets, low income, low assets. So maybe it all comes out in the wash. So Americans think you need about $2 million net of your mortgage, I guess, and in order to be a wealthy person. Where do you think that number goes from here? It might go higher, even if the stock market goes lower. You think so?
If the stock market goes low, I don't know. That sounds like a lot.
Okay. What do you think the average net worth of U.S. households is?
Well, median?
No. Average net worth. I know, the average is ridiculous, but...
Okay. I don't know. What, 400,000?
$750,000. So, meaning...
It's dumb because it's
all
so
right,
skewed.
the median is 121,700, according to the Fed. So, if you are within the median, if you are at that level for U.S. households, yeah, you probably look at somebody with 1.9 million and think they're Rockefeller, comparably speaking.
Right.
All right, let's get into
103.
Stay away from me tomorrow. Let's go right into viewer topics, and then we'll get out of here for the night. Duncan, where are you?
Hey guys.
What's going on, dude?
Not much. Good show, good chat. So
Yeah,
yeah.
and a special guest host.
I know people were wanting baby Batnick stock tips. So
Okay.
I don't know if you have any, but
He's mostly involved with crypto. I don't know if you could tell.
yeah.
But we'll
That's what
try
I
to
was
get
guessing.
to that.
That generation's super bullish.
All right, what do we got?
Okay, so up first, I'm 38 and have accumulated a portfolio of index funds over the years. I'm wondering if it makes sense to hedge for downside protection so that a market crash doesn't wipe out years of investing returns. Also, what is probably the best method of doing this? Long puts, short futures, etc. I understand that hedging. 38.
38.
I understand that hedging costs money and there's no guarantee that it will work as planned.
You shouldn't hedge the downside. You should embrace it. You should run into it head first. When the market goes down, you want to be buying more, not hedging.
Why are we hedging? Why are we hedging the market with 70% of stocks down 50% or more? Now we're going to hedge. It strikes me as a little bit. They say every general prepares to fight the last war. My method of hedging is not putting money at risk that I can't afford to. And I only have money invested in stocks that if they go through a period like this, I could live with it and not a penny more. And that way I don't have to worry about calls and puts and all that other shit. All right, what's the next one?
Okay, up next, Michael writes, what sector or stocks do you think will lead the way out of this bear market?
Oh yeah, Josh, that was me. I really wanted your take on this.
Yeah, this is a good one.
Well, history says it's never the stocks that led in the last. It's never the stocks that led in the prior bull market. I don't think that's ever been invalidated. So it's not that Apple, Google, whatever can't go up coming out of this. I wouldn't expect the bigger gains to be in those names. I would also skip growth tech, unprofitable tech. Again, many of those stocks will have some semblance of a bounce. Most of them will not be hot stocks again. I would not be surprised. Go ahead.
Go ahead. Finish your thought. No, go ahead.
I think it's defense stocks. I think it's industrial and defense. I think we're going to spend the next 5 years rebuilding our capabilities in this country to make our own semiconductors and be energy independent, and quite frankly, get back to fighting wars again. I hate saying it that way, but I think the entire world is arming up right now because we're back to this era of persistent worries about conflicts. And so I bought ITA and I bought IEO, and those are U.S. companies doing lots of business all over the world. In the case of ITA, defense spending, the U.S.-based energy producers, I think, are set up for high demand and a lot of political tailwinds. As much as Congress is going to chirp about how much money they're making, Congress does not want them to stop drilling. So I think that those are two places that you can expect to be part of the leadership coming out of this. I could be dead wrong. This is just what I think. All right, we're gonna wrap up from there. Turn that baby around. Let me say goodnight.
Oh, Logan, say bye.
Logan, say bye-bye to everybody. Almost as cute as Duncan, I have to say. Almost. All right. Thank you guys for watching. Remember, tomorrow is Wednesday morning. Brand new episode of Animal Spirits on all podcast platforms when you open your eyes. I'm Josh Brown. That was Michael and Logan Batnick. Thank you for joining us. Like and subscribe. We will see you next time.